In today's video, I'm going to go over another stock in my portfolio and the rationale for why I have it in there. So today I'm going to be covering another REIT, and that is Vici Properties. Now, Vici Properties is kind of a fun REIT, at least in my opinion, due to the properties it holds. So Vici Properties, it holds properties in the gaming, hospitality, and entertainment industries, primarily casinos, hotels, and restaurants in conjunction with the casinos and 4 golf courses. Now, Vici owns the real estate for all these properties, but leases them all out to operators like MGM or Caesars Entertainment, and then it has a taxable REIT subsidiary for the golf courses. If you go to Vici's Properties website, you can take a look at all the properties Vici owns. There's some pretty recognizable ones if you're familiar with Vegas at all. Caesar's Palace, there's Excalibur, Luxor's in here, the MGM Grand. They really do have properties all throughout the US, but they definitely do have quite a few in that Vegas area, just right on the strip. Now, I'm going to start off with a few of the concerns related to Vici and then end it off with some of the positive things, in my opinion, in summary of why I hold the stock. A bit backwards, but in my opinion, the company really does have some unique risks to be aware of. Now, starting it off, as an investor, you need to be aware that Vici is heavily tied to the casino and gambling industry. A large amount of its portfolio is related to casinos and gambling, and shifts in the industry could really just cause issues for Vici's tenants. Vici has done a little bit of diversification into other spaces with golf courses, resorts. They did a sale leaseback deal with Bolero, but it's still very heavily tied to that casino and gambling industry, which we'll get more to in a second. Economic downturns, reductions in casino spending, that could really just cause issues in that industry. Regulations, and another issue that's kind of come up recently, changes in tax law or other regulations could cause some problems. As far as those concentration issues I just mentioned, there's a couple of other things to be aware of. So, as of the end of 2024, 48% of Vici's revenue was related to rental income from properties on the Vegas Strip, which is expected somewhat since they are just so concentrated in the casino, gambling, and entertainment space. But this really just does create a dynamic where Vici Properties is heavily tied to the tourism industry in Las Vegas. Vegas has steadily recovered since the COVID-19 pandemic and has done well. However, it has seen a slight dip in traffic during the first part of 2025. There haven't been any major issues, and many experts are projecting a recovery later in the year and in 2026. But if that trend were a trend that were, if that decline was a trend that were to continue, it could definitely just cause some problems due to that concentration in the Las Vegas area. All right, so the other just concentration related risk I did want to talk about is the credit or tenant risk. So at the end of 2024, MGM Resorts International represented 38% of Vici's lease revenue, and Caesars Entertainment was at 36% of its lease revenue. So these two tenants just represent a giant portion of Vici's revenue, and then issues with either of those tenants could cascade and cause issues with Vici overall. MGM Resorts International seems to be doing pretty well, while Caesars Entertainment, they had a rough quarter and turned to a net loss, although it looks like cash flow from operations was still positive, and the company didn't have any issues paying its rents, as both of these companies are publicly traded companies. Might do a dive in a quick video or short, something else a little separate, just because I do want to look into these companies a little more, detail my findings and opinions on these two large tenants just because they are so key to VG's operations. Now, on to the positive. I just went and pulled up Vici Properties' most recent 10Q. So, Vici has been performing well with its adjusted funds from operations continually trending upwards. Adjusted funds from operations is a key metric here because, as Vici is a REIT, this can be a good measure of the cash flow the company is producing from its assets and can distribute to its shareholders. This is a non-GAAP measure, so I generally do like to keep an eye on the net income and non-adjusted funds from operations just to make sure there isn't anything funky going on there. If we look at the non-adjusted funds from operations, that number can fluctuate quite a bit here, just because along with the earnings per share, in this case, it was actually due to CECL or credit loss adjustments the company made. These adjustments weren't actually due to any realized losses or recoveries and issues in collecting rent, but just changes to projected potential credit losses due to risk analysis and the long-term duration of each of these leases. because Vici Properties has super long lease durations, could be like 30, 50 years, just due to the property type. Um, it has to follow different accounting rules, and it will make these projected losses or allowances for amounts that it could potentially not collect. This is similar to what banks do. Every quarter, they'll make different adjustments, whether they're actually not collecting on loans or not. It'll assess its risk. So Vici assesses its credit loss quarterly in accordance with generally accepted accounting principles and makes adjustments based on factors such as economic conditions, change in the debt rating of its tenant, and even the stock performance of its tenants. This is definitely an important number to pay attention to because if there really was a large jump, there's probably a good reason for it and could prompt some additional investigation. But as of now, this is kind of within the ballpark of what Vici has done for the last couple of quarters or so, and there hasn't been anything too major. One cool thing is Vici Properties has collected 100% of its rents from the company's formation back in 2017. So it's not a super long track record, but hasn't had any issues so far. The portfolio has maintained 100% occupancy and received all of its rent, so that's definitely a positive thing. Now, given the tenant concentration and just that the proportion of its rents are from two tenants. I'm really glad that's the case because if it was less than 100% due to that tenant concentration, whether it's MGM or Caesars Entertainment, it does have a lot of tenants that it just has multiple properties leased to. So in general, we would really hope this occupancy stays really high, maybe aside from a one-off if it had a single smaller tenant that ran into issues. But if one of these bigger tenants ran into issues, this would be a problem. So Vici Properties has had a trailing four-quarter dividend payout of about $1.73 per share and forecasted adjusted funds from operations to be to $2.35 to $2.37 per share. This would result in an adjusted payout ratio of approximately 73.6%. If you Google Vici's payout ratio, it'll actually calculate a little lower due to some of those credit loss adjustments. The payout ratio is right in line for a REIT, and the company has a strong dividend growth each year. Overall, the company has performed well, a solid history so far, but the REIT is fairly new. I like the real estate and just unique property type, but while the industry risk doesn't have me super worried right now, the tenant risk is a little concerning to me, at least with the high concentration and that recent performance of Caesars Entertainment. Caesars Entertainment is a company I'm definitely going to keep an eye on just because I don't love what I'm seeing there at first glance, especially on the Vegas Strip side of things. But thanks for watching. Let me know if you have any comments or interesting stocks I should go and check out.